Consumer confidence is tanking. Tariffs most likely are going to refuel the inflation fire. And that's when I actually put the video out 4 months ago. I kind of saw this picture, but I'm like, I can't believe they're going to let this happen. It's called stagflation. Today, inflation numbers came out really, really sticky, 2.7. So inflation is not going down to the Fed's target of 2%. Unemployment is kind of ticking up now, and consumer confidence is in the toilet, and our GDP is based 80% on consumer spending. You guys see the macro picture now? This is the thesis. So if you're here, Marcia, that's the thesis. The macro picture is looking shaky at best. Market is not priced in a slowdown, let alone a recession. Market definitely has not priced in a stagflation scenario, which you guys will hear this now pretty soon on CNBC. The talking heads will go like, oh shit, consumer confidence is kind of tanking. Everything we're going to buy is going to be more expensive because of the tariffs. Well, that stagflation stands for stagnant economy with inflation. So it's stagnant, STAG for stagnant, inflation from inflation. There is no cure for that. So truly there's no cure for that. Now, again, I'm not being gloom and doom. I am just saying what I'm seeing. I'm talking about what I'm seeing. Gloom and doom is not my world. I didn't become successful because I'm like gloom and doomer, or what do you call those, perma bear and perma bull, all these things, a YOLOer and hodler and all that stuff. So I try to make sense of things. That's my analytical mind. So macro picture is getting cloudy. Okay, cool. Well, market's responding now. So before 2 years, every piece of bad news that we received, what did the market do? 2-3% sell-off, it was bought. New high, new high, new high, new high. This is the first time the market's actually reacting badly to bad news. So that's the first sign of change that you guys need to pay attention to. How something behaves. Sometimes earnings will come out on a company. It'll be horrible earnings, but stock will go up because all the bad news is in the market already or in the stock already, right? So this is the same thing for the indexes. When the indexes start behaving badly, meaning it gets sold off on bad news, that means they're taking the bad news seriously, and that means it wasn't priced in. The market is the greatest pricing mechanism on the planet, okay? It prices things in before they take place. You're going to say, well, what if the market is wrong? Well, market is never wrong. Why? Because it's the truest scoreboard. The price you see is the transaction price by the billions of dollars at that second. The price could be wrong. Some analysts could be wrong. The Fed is definitely wrong. I don't know about the administration now, but what I'm trying to say is that you can't argue with the market. There's a buyer and there's a seller. A transaction happens. That's the price they put up. Could it be wrong in the next 10 seconds? Of course. But one of those two sides is going to be wrong. So it's not as easy. So couple that now, what I said on the macro side, with the technical side. Some people, say technicals just tell the past. They don't talk about the future, and I agree. However, technical analysis is something that a lot of people look at. So when a lot of people are looking at the same thing, they're looking at the same damn chart as I'm looking at. Now, the interpretation of it could be a little different, but there are some basics of it that you can't get away from.